So, good day, dear investors. It's my pleasure to welcome you from Orient Securities office here in Vilnius. And today we want to talk with you about bond investment case, bonds issued by closed-end investment company Atsinaujinančios energetikos investicijos. It is an investment company managed by Lord LB, one of the largest asset management groups here in Lithuania. And the company is issuing 1 and 2 year bond issues, so 2 separate issues. And today we're gonna present it. Myself, I am Mykantas Urba, head of investment banking here at Orient Securities. And today with us, we also have Mantas Auruškevičius, who is a manager of investment company Atsinaujinančios energetikos investicijos, so manager of the issuer. Straightforwardly jumping to the main terms of the bonds. So the company is not a newcomer in the Baltic capital markets. Actually, a company has issued 90 million bond issue 4 years ago in 2021 and attracted capital which was successfully used to develop currently owned renewable energy asset portfolio. Also in summer, we have done exercise targeted towards more institutional, so wholesale investors. Bond issue was placed with minimum investment amount of 100,000 euros. And now, so in the autumn, we are coming with a follow-up issue, which is already suitable for retail investors as well, because minimum investment amount is one single bond, meaning 1,000 euros. So this this bond, which is also available for retail investors, is issued under total 50 million euro program, and with this first tranche, the placement of which spans till the end of October, 31st of October, the size of this tranche is 25 million euros. Investors are being offered 8.5% fixed coupon, which is paid out semi-annually. And also differently from the bonds which have been initiated in June, and we have also a follow-up issue which we'll talk about later on. This wholesale institutional bond maturity is 25 months. This retail-oriented bond is 13 months length maturity, so it's 1 year versus 2 year. Use of proceeds is mainly money attracted to be used for the refinancing of what I mentioned, bonds issued in 2021, which are maturing at the end of this year. Also, a short overview of the term sheet. So what I have already mentioned, minimum investment amount, 1,000 euros, 8.5% coupon, 13-month maturity. Also worth mentioning is that though bonds are not secured with a pledge, it is a senior unsecured type of bonds. However, quite strict covenants are applied for the issuer. Main of which are equity ratio. So standalone issuer's equity ratio has to be larger than 50%, ensuring that at least half of the balance sheet is composed of the equity. Mantas will mention later on. Actually, now the equity ratio is around 53%, and the only liabilities which the investment company has is actually bonds. Also, we have a leverage ratio covenant, which states that it cannot be larger than 75%, and it is being applied both to investment company level debt and also project SPV senior debt. At the moment, this covenant is around at 66%, so still plenty of buffer room till the covenant threshold. what I mentioned, maturity roughly 1 year. However, the issuer is also provided a call option to call the bonds after half a year. So starting with 4th of June 2026, the issuer can redeem all the bonds. Why such a possibility is placed? Because the company is in the last investment stage. So company has completed majority of plant assets, which are already a significant part of which is operating, and company is entering already divestment stage. And since divestments are planned already next year, if significant divestment is made earlier than the final maturity date, the company needs this flexibility to be able to cover the bonds earlier than end of next year. What's also important to mention, current bond holders, so holders of the bonds which are maturing in this December are provided opportunity to switch the bonds to newly issued using central depository corporate action method. So if you are owner of these outstanding bonds, you can conveniently via your investment bank interface simply apply for a switch with a click of several buttons. The term to provide this switch orders is the same as for replacement. So the last date is 31st of October. So that's a very short introduction about the bond structure. We'll come back to it later on. And now I'm giving the floor to Mantas, who will present the issuer strategy and talk more about the market.
Yes, so thank you, Mykantas, for the introduction. So as mentioned, AEI is a closed-ended investment vehicle, which was established in the year 2020. During the first years of company's operations, we have raised 182 million euros of capital, which half of it was raised through equity, and the remaining half, 91 million euros, was raised through green bonds, which we are currently refinancing. So since 2020, the capital was deployed towards development and construction of solar and wind power assets in the Baltics and Poland. And at the moment, our generating and operating portfolio consists of 280 megawatts of assets, out of which 185 megawatts are operating wind assets in Lithuania, with the remaining almost close to 100 megawatts of operating solar PV assets in Poland. As the construction of our core portfolio is being finalized, we expect that the operating capacity will increase by additional 69 megawatts of solar PV assets in Poland, as the projects are basically finalized, and we are just waiting for the grid operator to connect the projects to the grid. In terms of our whole portfolio and megawatts, so it's rather large, 1.8 gigawatts, but the majority of these assets are development stage assets, meaning they do not require significant capital injections to develop them. Based on our current investment strategy, as Mykantas mentioned, the investment company, it's nearing the end of its life cycle. Basically, we are in the process of selling all of the assets that we have on the books. So these development stage assets, together with our operating and construction stage assets, will be sold in the next year or two. And this divestment stage has started already. We sold our first core portfolio project at the end of 2024, where we divested 65.5 megawatt solar PV portfolio in Poland to a large UK-based infrastructure investor, which could be one of the candidates to acquire the remaining solar portfolio in Poland as well. So we kickstarted the divestment process last year, and we expect that the divestments will follow through in the next year or two, according to our investment strategy as well. Key things to point out about the issuer and the investment company itself from the bondholders' perspective is that we have a strong balance sheet. More than half of the assets on the books are financed by equity, meaning there's a significant capital buffer in front of the bond and debt investors. And also our operating portfolio is already generating significant EBITDA, which we expect will increase next year when we will energize and have the full solar portfolio generating electricity in Poland. One more thing to note as well is that the electricity that we sell in our operating assets, part of it's hedged via PPA, long-term power purchase agreements, or we use government subsidy schemes such as CFD auction tariff in Poland, which allows you to sell part of the generated electricity in Poland under the fixed tariff for 15 years, and the tariff is indexed every year as well.
Yeah, short interruption. If you have any questions, please submit it using Q&A interface. We will cover it after we go through the slides. Yeah, please continue, Mantas.
Here on the screen, you can see our capital structure on the issuer and the whole group level. I think you should pay attention to the column in the middle, which shows our capital structure in the middle of this year. So as mentioned, the equity, the fair value of equity on the investment company level is equal to 96.5 million euros. The only debt obligations that we have on the investment company level are the green bonds issued, which are equal to 84.7 million euros. And we also attract debt on the project level because we are attracting debt on a two-level basis, meaning we attract junior bonds on the investment company level, and we attract as well banking or project finance from debt funds as well. So this the total amount of the debt is equal to 100 million euros there. So fairly healthy capital structure. The equity covenant that we have at the moment, as Mykantas mentioned, so the equity ratio is 53% at the moment. It cannot go below 50% according to the covenants we have under the Green Bonds program. And the total consolidated group leverage is at the moment 66%, and it should stay under 75% based on the covenant levels we have. Now here on the screen, you can see the summary of our investment portfolio in terms of megawatts and euros. So the fair value of the investment portfolio, you can see it on the chart below. But basically, you can see that our portfolio is fairly diversified in terms of technology, in terms of geography and the development stage. So we have fairly good diversification across solar and wind technologies. In terms of geographic allocation, so more than half of the fair value is currently allocated in Poland, with close to 40% in Lithuania and the remaining assets in Latvia. And in terms of development stage as well, more than half of the assets are already operating. It currently stands at 58% of the total portfolio's fair value. With the assets under construction, they currently consist of 1/3 of the total portfolio, but we expect that this will shift towards the operating side significantly towards the end of this year. As well, on the table above, you can see that we have a large pipeline in development, 1.3 gigawatt. But these assets, as mentioned, will not be further constructed at this investment vehicle. They will be divested, sold when the assets will reach ready-to-build stage, which is scheduled for the majority of the assets to happen by the end of this year. Here's a fairly good summary of all of our investment portfolio on a project level. So basically, you can see all of the assets, separate assets that the investment company owns in terms of ownership, technology, the stage that the assets are in, the revenue hedging strategy that we are applying, as well as the fair value of equity of these assets, along with the operating financial results for the previous year and first half of 2025. So the main message here is that top 3 assets that we own, these are operating and close to operating stage assets in Lithuania and Poland. As mentioned, assets in Poland are expected to reach almost fully operating stage by the end of this year, with the remaining assets energized in Q1 of 2026. So basically, by the first quarter of next year, we'll have all of our solar portfolio in Poland energized. And you can see in terms of fair value, so the third column from the right, these 3 portfolios consist of majority of our investment portfolio. The 185 megawatt wind portfolio Lithuania, so the equity investment there is valued currently at 50 million euros, with the second and third assets, which are the solar PV assets in Poland, combined valued at around 85 million euros. So all of our basically assets you can see on the screen, they are in the divestment stage in one way or another, meaning that we either are divesting the assets ourselves, connecting with potential buyers and then running the process ourselves, or we have M&A advisors in place who are divesting the assets to the broader market, either as standalone investments or divesting them as a platform, meaning that the whole portfolio can be sold in a single transaction to a large strategic player. All of the assets following the fourth line, which is the 112 megawatt construction stage wind portfolio in Latvia. So as mentioned, they are in development stage, and we do not expect to inject further significant capital into them. They will be divested once they reach ready to build stage. So we also expect an increase in fair value for these assets, as currently they are basically valued at cost, basically the grid bonds that we have posted for them. Once the asset reaches the ready to build stage, according to the valuation methodology that we are applying, then those assets are valued using discounted cash flow method, and as well as doing comparables analysis as well. So we also expect an uplift towards the end of the year once these assets have building permits in place. Here you can see the graphical summary of the investment portfolio, basically the total value of the investment portfolio by the middle of this year, as well as the historic values, and also the split between projects. So as you can see, the bottom 3 assets consist of majority of the assets asset value, as they are currently operating or close to being fully operating, and all of the assets above are still, let's say, in construction or development stage. So the valuations there are lower. But with the assets jumping through the development stages, we expect also an increase in fair value for them as well. Going at core portfolio assets one by one. So our 185 megawatt operating stage wind portfolio in Lithuania, our flagship investment, basically it's fully operating. We have long-term financing in place, a 25-year fixed interest rate senior debt financing. We have a long-term 10-year PPA, which allows us to sell half of the generation under the portfolio for a fixed price. So basically the asset is, let's say, fully de-risked from the development perspective. And we expect to basically move forward with the divestment, next year, and it could be one of the assets which can leave our portfolio shortly.
And it's developed with your investment partner.
Yes. So in this asset, we only own 25% there. The remaining 75% are owned by Taleri Energia, a large Finnish asset manager with a broad renewable energy strategy across North America and then Europe. So they own the remaining 75%, and they are our strategic partner in the majority of our development stage assets as well. Talking about our Polish assets, so two solar PV portfolios in Poland. So the first one, 67.8 megawatt solar portfolio spread across 36 different separate projects across Poland, as you can see in the map. The construction for this portfolio is finalized from our end. We are waiting for the grid operator to finish his works on the grid side, meaning preparing the grid connection point, after which we will just connect our assets and fully energize the portfolio. So by the end of this year, we expect that around 50 megawatts in total will be operating, with the remaining 18 connecting to the grid by Q1 of 2026. Out of the 68 roughly megawatts, 63 have acquired the CFD tariff in Poland, which allows us to sell part of the electricity generated towards this CFD or fixed tariff scheme. And as the index as the tariff is indexed every year, we expect to sell the majority of the electricity generated towards the final years of the tariff, with the first years of generation. In the first years of generation, only a small part of the electricity is sold under the fixed scheme. Majority of the electricity generation is subject at the moment towards merchant risk, but once the whole portfolio will be energized, we expect to also secure short-term PPA contracts to hedge part of this merchant risk when the project is de-risked, of course, from the construction risk. We have a long-term financing in place from one of the local commercial banks in Poland. So once this asset is fully energized, it will be basically de-risked and ready for full divestment from our end. The second investment portfolio in Poland, 114 megawatt solar PV portfolio in Poland, 16 separate projects spread across Poland. At the moment, we have 46.5 megawatts in operating capacity. We expect to energize around 20 megawatts actually today, with the remaining assets being energized by the end of this year, according to the current construction schedule. So basically, at the end of this year, the whole 114 megawatts will be energized. Out of the 114 megawatts, 92 megawatts have acquired the same CFD tariff with the same strategy as in the previous portfolio. And we also have a construction bridge financing in place from EBRD and one of the debt funds in France, Eiffel Investment Group. So this bridge is being refinanced at the moment. We expect to close the deal at the beginning of next month, where the construction bridge will be replaced by long-term senior debt project financing facility under the higher leverage, which will allow us to refinance part of the equity injected in the portfolio, upstream it back up to the investment company level, and use those proceeds to redeem part of the bonds outstanding towards the end of the year. So basically, with the portfolio being fully energized by the end of this year, with the senior debt facility coming in next month, this project as well will be fully de-risked from construction and development risk, and we expect that it also will be fully prepared for the investment next year. All of the assets in the table here and the other table that will follow, these are basically all of our development stage assets, which, as I mentioned, do not require significant capital injections. We expect to divest these assets when they will reach ready to build stage, meaning they will have the papers in place to construct these assets. Most of the building permits are coming towards the end of this year. Once we'll have those papers in place, the assets will be also up for divestment. And as I mentioned, the process for divestment has already started, so it will be basically aligned with the receival of the building permit. Why are we not constructing the assets ourselves? The reason is simple. We are limited in terms of capital we can raise under this investment vehicle, as it has limited life cycle. The investment company's life cycle is 7 years from the first inception. So basically, our life cycle ends in February of 2028. So basically, we have 2 years to fully divest our portfolio, which is not enough time for us to construct these large mega assets in this investment vehicle, and that is why we are placing them up for divestment.
But there is a market also for ready-to-build projects, not only operating.
Yes. So the good thing about renewables is that the assets are fairly liquid in various stages of its investment life cycle. So once the asset comes from the development stage to building permit stage, there's a significant, let's say, increase in value, and also the appetite for the investors increases, as a lot of international players are now scouting the market for such kind of investments, meaning large hybrid assets with the building permits in place. So we'll probably just utilize the market opportunity and divest these assets with the building permits in place. Now, talking about divestments, so as I mentioned at the beginning of the presentation, it started with the first large divestment at the end of 2024, where we divested our first core portfolio project, 65.5 megawatt solar portfolio in Poland. The development of the asset was completed in 2020. We divested it at the end of 2024. To a large UK-based infrastructure player, netting a project IRR of close to 17%. This divestment kicked off the start of the divestment period at the investment company level, and we expect that all of the remaining divestments will follow through in the next year and the year after that. Talking about the current renewable energy environment in the region, so basically Baltics, Poland, and the wider Europe as a whole. So we can see that the renewables development and construction is non-stopping, with the various market turbulences that we experienced in the last, let's say, 5 years, the energy price crisis, the geopolitical risks that are facing the region, as well as the supply chain risks, which materialized 3 and 4 years ago. The development is still ongoing and going strong. None of the EU countries are backing off in any major way from their renewable energy targets. We see countries as Poland continuing their subsidies, continuing to organize the 15-year CFD tariff auctions. We also see the developments in the Baltics as well, where you can get subsidies for the battery storage projects, which are basically kicked off the significant development of this technology as well. So none of the regions in the country are backing off from the renewable energy targets. They are continuing to support it. And from what we can see internally, after the few slow years that we had in 2023, 2024, when the energy prices stabilized from the peaks that we had in the year 2022, with the cost of capital still being high, a lot of, let's say, smaller players had to leave the market, with only the big infrastructure guys remaining, which can attract, let's say, significant amounts of capital to continue the development and construction of this infrastructure field. We can see a uptick in the market in terms of interest on the M&A side. We actually, after just this summer, we we got a significant interest to acquire our investment portfolio in various stages, in the various groups, as a standalone asset or the group of assets. And actually, the interest is coming not from the local guys, but more from the international infrastructure players who are looking at the Baltics and Poland as well as their next geography in terms of expansion. So we think we are well positioned, to use this market opportunity and divest the assets at the right time. Now going to the project level and the economics of renewable energy projects. So the main driver is, of course, the energy price forecasts that we have. So there are many forecasters in the market, with many of them applying, various assumptions when forecasting 30 and 60-year energy price curves. So, this always take it with always, we're thinking it as some sort of horoscope, as we joke internally, as it's really hard to forecast, a 5-year electricity price curve. So when we're talking about the 30 years, the chances, for error are quite significant there. But all of the long-term electricity price curves that we're using, and then we see they still point to the fact that electricity will be higher for longer, much higher than the historic levels we had, let's say, pre-2020. And the levels that are being forecasted are sufficient, to earn significant infrastructure-like returns for the renewable energy assets. You're just basically, you have to make the decision at what stage of investment cycle you want to join in, either at operating stage or construction stage, which attract different risk premiums for your investment. In terms of demand, so all of the forecasts point towards the stable and growing demands in the region, in the Baltics and Poland and the wider Europe as a whole. Of course, there was a discrepancy, I think, between the forecasts and the actual results, and then, let's say, the first 3-4 years after COVID, where the industry still did not pick up to the levels it was, pre-COVID. So the demand, let's say, was not there, but what we can see, looking around the region, the demand for electricity is growing due to the electrification process that is happening, in the real estate industry, manufacturing, and so on. But also we see that new electricity users, new demand players are coming into the market with the upcoming AI boom. I think you saw the news, what is happening in the US, that let's say there's a real fear that the AI boom will be basically bottlenecked by insufficient grid capacity and insufficient green electricity generation. So everyone is throwing all their effort in increasing the grid capacity, increasing the green electricity generation in North America. We also see the signs of this happening in the Scandinavian countries, where we visited. We met with the local investors, and they say, yeah, this is the same case with us. More than, let's say, 40% of the new applications should connect to the grid, for example, in Norway, are by data centers, and with the forecasts that they have, they see that they will not be able to meet the upcoming data center demand for these big technology companies, which are branching out from North America to Europe. So with these themes, we also expect that they will come to the Baltics and Poland as well. In Poland, we already see the data center boom growing. For example, around Warsaw, there's significant data center development, which is, let's say, not only on paper, but there's actual construction going on. So we think that the same trend will also come to Lithuania, Latvia, and Estonia. We've met with, let's say, potential players who are, let's say, building data centers across the world, and they say, at the moment, we do not care where it is. Baltics, Poland, just give us grid connection, give us green electricity. We do not care about if there's like a water source nearby to cool off the data center capacity, or whether there's any geopolitical risk. We just need a place to connect the data center and green generation. So we'll see how this develops, but it could lead, to another energy shock where the upcoming new demand players will not have sufficient energy resources in place.
Also, maybe what's worth mentioning is difference between Poland and Baltics, because
yes,
as of now also we see a spread in
yeah. So as you can see on the, let's say, the regional electricity market price forecast graph, there's a spread between Poland electricity price curve as well as the Baltics. So the Baltics follow a fairly similar trend, while there's a significant gap between Poland and the Baltics as a whole. This is due to the fact that Poland is still significantly subject to their energy and electricity demands being covered from coal sources or fossil fuels. So more than 60% of the energy generated there is still being generated from fossil fuels. So they still have a lot of work to do. As you can see in the graph, the gap shrinkens in the future, but there's a still significant, spread between the two regions, which is, weird given how close we are to them. But yeah, Poland still has a lot of work to do to fully replace their coal and the fossil fuel based energy sources, and it will take a lot of work. That's why Poland is throwing a lot of money into subsidies for the renewable energy technologies to fasten and strengthen the development of these assets in the country.
Yeah, thank you, Mantas. Now we will switch back to talking about more the offering, the bonds. So, of course, as always, before making an investment decision, we encourage all the investors to go through the risk factors, a full description of which is available on the base prospectus published by the issuer. Just summarizing what we see on the screen, I would say that risks related to the business, to the group's business, what was already mentioned by Mantas is, of course, electricity price is one factor inputting some of the risk. As mentioned, PPA and CFD, partial hedging of the revenues, is used to mitigate this risk. But nevertheless, of course, if electricity price forecasts somehow changes down a bit, it can affect also the value of the projects, and of course the proceeds the company would get from selling these projects. So I would say that this is the most specific general factor. Of course, we have a macro environment, weather or sunshine factors as also affecting the business. But prices of electricity is one of the most important macroeconomic inputs, let's say. So moving towards risk related to the growth strategy and divestment, of course, capital price and price of available capital is an important factor. Maybe for the company is not too much, because a significant part of the project portfolio is already built and or will be launched soon. However, of course, when selling the assets, buyers also pay attention to what's the current price of the capital. And I would say that divestment risk, so being able to successfully sell the portfolios and at an optimal price, I would say, this is one of the key risks in this investment. Of course, we also have quite a strong equity buffer in this case, so I would say that this is risk more maybe toward to equity investors, but not to bond investors. Of course, regulatory market is quite regulated, but again, getting building permissions is more specific to greenfield investments. In this case, when you have an up and running project, this regulation is less important, but still poses some risk. Switching towards the next slide, of course, we always have, when investing in bond-specific risks. Yes, these bonds will be listed on NASDAQ main debt market. However, of course, liquidity is not guaranteed. So if investors is willing or decides to sell the bonds before the maturity on the secondary market. Of course, there could be a price fluctuation due to interest rate changes, due to inflation and other factors. So investors having shorter term still, despite the fact that this issue is quite short, you should consider also these liquidity related risk factors. So before finishing, I'm coming back to the structure. So as mentioned in this slide, we are more focusing towards what we call retail offering because of the smaller minimum investment size, which is 1,000 euro. As said, the total tranche issued under this retail program at the moment equals 25 million euros. In parallel, we also have running a tap issue of the green bond program, which is targeted more towards wholesale investors because minimum investment amount is above 100,000 euros. So what are the differences of these issues? One of the main, I would say, maturity. Retail-oriented bond is roughly 1 year maturity. Wholesale-oriented bond is 2 years maturity. We have a slight difference in coupon, but the main difference is investment amount. In the first option, you can invest as low number as 1,000 euros. In a wholesale issue, it's 103,000 euros. What's also worth mentioning, besides these cash offerings, we also have, as already indicated, a switch offer for the holders of currently outstanding bonds, which are maturing at the end of the year. Investors can switch their bonds through a Nasdaq Central Depository Securities event. So again, you should just visit your financial intermediary website and submit an order to exchange. The minimum exchange amount is 100,000 euros, so 100 old bonds to be changed either to retail offering or to the wholesale offering. Subscription procedure, I would say, is fairly standard for the bonds which now we see placed in the Baltic market. In order to invest, you have to have an investment account opened with a bank or a financial brokerage company in Lithuania, Latvia, and Estonia. And as we checked, I guess all the market players have possibility to submit the orders via in their investor portal and investor interface. So with a couple pushes of a button, you can subscribe for the bonds till, as mentioned, last day of October. So the offering started last week, 15, and is running till 31st of October. We plan allocation and results to be announced in first Monday of November, so 3rd of November. Settlement will take place on 4th of November. So this is the date when these newly issued bonds become valid, and this is the day when the investors will see their bonds in the securities accounts. Just before finishing, coming back to the term sheet. So as mentioned, up to 25 millions, minimum investment amount 1,000 euros, maturity 13 months, so a little bit more than 1 year. We have a fixed 8.5 coupon, which is paid out semi-annually. Security is enhanced by financial covenants, which are put in place. So standalone equity ratio at least 50%, meaning that always there should be at least equally equity and debt capital on the issuer level. Looking on a consolidated level, so including also project SPV company debt, maximum leverage is not larger than 75%. So both of these covenants are targeted towards ensuring that there is a substantial and significant equity buffer to mitigate bond investor risks. As mentioned, there is also early redemption in place, which can happen as quickly as the beginning of June. And bonds will be listed on Nasdaq main market. And again, technically, we also encourage to see current holders of outstanding bonds that there is a technical possibility to switch the bonds without any cash transaction, switch 5% yielding bond to this newly issued 8.5% yielding bonds. And a final slide, key investment highlights, which have been covered by Mantas as well. Of course, firstly is the main focus towards a strong financial position of issuer. As indicated, the total value of portfolio is above 160 million, out of which equity is around 90 million euros. The company's assets, renewable energy assets, are fairly advanced stage. We're already generating cash flow. EBITDA generated by the portfolio in 2024 was more than 8 million euros. Advanced project stage, meaning that we are operating, but also that the divestment process is just around the corner. As Mantas mentioned, it is already initiated, and it is planned that in the nearest period, divestments will take place. And we see this bond, I would say, more as an additional bridge instrument for the issuer, to enable the issuer to finalize the investment company cycle and divest these portfolios within the 1 year maturity, so in year 2026. So we just gone through the slides and can switch to the questions. I see we have quite a number of the questions. First question about financial accounts and profit and loss accounts. Upon reviewing the financial statements, I was not able to identify revenue from solar and wind parks. Would you please explain where is this revenue reflected? So maybe a bit how these assets are accounted on a investment company level.
Yeah, so on the issuers level, AEI level, we do not do the traditional consolidation of the balance sheet of all of the subsidiaries and associates. What we do is the issuer applies investment entity accounting approach, which means that all of our investment portfolio, the equity of each of the investment is accounted under one line on the asset side, meaning the investments at fair value. So we do not consolidate the balance sheets in a traditional way. We only account for the fair value of equity of each of the investments on the issuer's balance sheet.
So revenue basically consists of revaluation.
Yeah, and all of the revenue, let's say projected revenue, is included in the fair value valuations, which are done annually. So you do a valuation, you value, let's say, your investment, and that fair value is then booked on the AEIs, on the issuer's books, basically.
And of course, when the projects are sold, it's also reflected.
And when you sell the project, so then either you have, let's say, a gain or a loss based on the value you were able to divest the asset. And the only, let's say, significant profit and loss values that are coming into the profit and loss statement on the investment companies' accounts are, let's say, the changes in the fair value portfolio. So basically, let's say this paper value, which you account for, and if in 1 year it increases, then you book a gain for that year. If it decreases based on the fair value valuation, then you, let's say, book a loss on the books of the issuer.
Yeah, but also worth mentioning that on a quarterly basis, you also publish a fact sheet of investment company.
Yeah.
And it has information about these operating SPVs and what revenue and what EBITDA is generated by these assets. So it's also disclosed despite this specific consolidation method. Also another question about EBITDA revenues. switching towards projects, why is EBITDA for several operational assets negative in 2024 but positive in 2025?
So this concerns our solar portfolio in Poland. Basically, as the assets were not generating electricity last year, projects are just, let's say, significantly coming into operations this year. So in the year 2024, we generated a negative EBITDA. These are basically, let's say, not capitalized construction and development costs. So this EBITDA should shift to positive one. As I've mentioned, we should have a majority of our solar assets operating by the end of this year. So the next year, starting January, those projects will be fully operating, earning EBITDA. And yeah, that's why the shift from negative to positive.
Another related question. Does operating profit service with debt, or will service the EBITDA running?
Yeah. On the project level, as well as on the issuers level, we expect that once the assets in Poland are fully operating, the upstream of dividends that we'll have annually from those projects will be sufficient to cover the interest rate on the bonds that we are placing and we have on the issuers level.
Couple of questions about exit. How do you see the current environment activity for exits in Poland versus Baltics?
So Baltics have always lagged in terms of M&A activity. Poland is much larger market. More deals are done, more international players there. So the market is always active there. In Baltics, you have to look for investors. I mean, in terms of, let's say, the assets that we have and the size of that, there's only, let's say, a limited number of potential buyers that can acquire such portfolio. So before, it was only basically the local guys, so the local electricity generator type companies, local utilities, I mean. So we had like one or few M&A deals done by like foreign capital players, but it was mostly local. Now, as we shift to today, we see a significant increase in interest from international capital, who, based on their, let's say, new and updated investment strategies, are now looking to acquire projects in the Baltics. So there's uplift in M&A activity there and interest there. But yeah, I mean, Baltics and Poland, two different animals. Baltics will always lag in terms of M&A deals and the types of players in each of the markets.
So also a related question about geographies. Did you consider also investing in Estonian market? And why no Estonia?
Yeah, I mean, Estonia is there in our investment strategy, but throughout those like 4 years, we have never found like a good investment opportunity. So if we'll do Estonia, it will probably not be in this investment vehicle.
Exits. On average, how long does it take to exit one project asset? So maybe your experience in 2024 and plans for upcoming exits.
So on the deal that we've done in 2024, it took us a year basically to divest the asset from the first offer that we got to the money in our accounts basically. The process took significantly longer than expected, just because during the due diligence, we have identified some of the, let's say, not like significant issues for project operations, but basically some documents had to be done in order. So this took a while, just the whole paper pushing in Poland and the bureaucracy that you encounter there. So due to this, the whole divestment process was prolonged. In terms of new divestments, we are targeting 3 to 6 month divestment window with interested parties, depending, of course, on the size of the deal. If you're doing the whole portfolio divestment, it might take longer, let's say a year. But yeah, subjective. I mean, depends on what you're divesting.
Yeah, about the leverage. You have a 75% covenant in place. So total leverage. Does the issuer intend to further increase its leverage to close to 75 or?
Yeah, it will increase with the upcoming, let's say, refinancing of solar PV assets in Poland. But it will not trigger the covenant levels. I mean, we still have a fairly safe buffer, to increase the leverage on the portfolio basis. Yes, but it will not breach the covenants that we have in place.
And also, a significant part of this additional debt would be used to redeem.
Yeah.
What are the key risks, from your opinion, that could lead to the default of bonds? So we have covered the risks, but what you see yourself as key factors to solve?
Key risks, I mean, any like black swan events, geopolitical risks materializing. From the bondholders' perspective, I mean, I would say the primary risk for this is the timing of the divestments. I mean, whether they can be executed in time to redeem the bonds, as we have a fully operating portfolio at the moment with more megawatts coming into operating capacity towards the end of the year. I think it will lead basically to the how fast the divestments are done.
Yeah, but you're quite confident that
it's basically a matter of price. If you want a lot of M&A activity, you can sell everything at whatever price and be done with it. But we are here, to maximize the value of our assets. So this is, I guess, the primary thing.
And also we have, a bit could be related question. Why is the company issuing bonds in different maturities? So that's also maybe to comment that this 25 million, what we discussed, it's possible to cover from sale of one asset, and we have another part in 2 years. So
yeah,
I guess it's also to mitigate the exit risk.
Yeah. So just because any, as you see on the screen, any divestment of one of the 3 top portfolio assets at the moment will be sufficient to cover significant amount of green bonds outstanding. So in case divestments will happen, let's say in the year 2027 for the remaining assets, that's the divestments from those proceeds there will be used to cover the remaining bonds. So we're splitting the tranches. And as well, we see that probably in the market, the investors might lean forward towards the 1-year issuance as well. So both strategic and, let's say, we're using the market opportunity here.
Okay, thank you. Question about the shareholder structure. So who owns the IAE? So maybe a bit about the fund and who are the main investors?
Yeah, so Lords, I mean, if we look at the whole structure, they have we have basically a majority of the high net worth retail institutional investors in various investment vehicles. If we're talking about specifically about AEI, it's primarily high net worths.
So basically high net worth investors from our region.
Yes.
Another question jumped in regarding the sale. Are your assets meant more for strategic or financial investors to purchase? You see yourself.
We would probably, of course, prioritize strategic divestments as they generally yield higher valuations. But as I mentioned, for example, in the Poland's case, once we'll have fully energized portfolio, we can sell it to strategic, but let's say if a financial player comes with a right price, but they would like more of the generation, maybe even on the debt side, some hedging implemented, then we'll structure the final product in a way where it can be divested to the financial. So of course, we always prefer the one who pays the most, and usually it's the strategics.
How do interest rates affect valuations you see in the market?
So every year when we do evaluations, I mean, the cost of debt is included in the WACC calculations, the discount rate calculations. So I mean, we have it has a direct effect in our evaluation process. So when the cost of capital increased, I mean, yeah, let's say this is one of the primary, not the primary, but it was one of the negative assumptions which let's say can influence the devaluation of some of the assets when calculating, let's say, the cost of capital. So yeah, I mean, all of the macro trends are included in the valuation process.
And maybe this was one of the reasons also for slower M&A operating.
Yeah. So as I mentioned, I mean, when we had high energy prices in the region in the year 2022, 2021, so despite rising cost of capital, everyone was running to the renewables because, the valuations made sense at the time. But once the price stabilized, the cost of capital was still in, let's say, fairly high levels historically, and higher cost of capital than would be preferred for renewables. So that's why, we had a slowdown and decrease in M&A activity in the region, plus also the geopolitical risks that we have. So these were one of the factors.
Okay, yeah, thank you. And one question, quite technical, about investment. Who should I contact regarding the forms to be filled out about withholding tax in Lithuania? My understanding, the tax will be withheld from the coupon payment if the necessary forms are not filled out timely. Applies to investors outside Lithuania. Yes, so this is correct. If you do not submit the form, it would be withheld. You can submit the form either to the issuer directly or to Orion Securities, which is a securities account manager and representative of issuer for this issue regarding the bond accounting. So you can also send this form to a general email of Orion Securities. So these are all the questions we have successfully covered. So we really thank you investors for giving your time to us. I also thank Mantas for participation. And as indicated, the offering is spanning till the next Friday. So we really encourage you to deep dive into the information memorandum and presentation. If you have any additional questions, do not hesitate and contact Orion. We will try to answer it. And take decision and make an investment. So thank you for joining us today, and have a nice remaining of the day.